Welcome to the i6 Green Challenge webinar on venture investing trends and crowdfunding. My name's Rebecca Hefcock. I'm a project manager with the CleanTech Open i6 Green Challenge team, and I'd like to thank all of you for taking the time to attend this webinar today. The purpose of today's webinar is to provide an overview not just of crowdfunding, but also of current venture investing trends and how these are changing in order to give you some insight into how to be more successful using them. Now I'm going to pass the mic to Ed Murray, Program Director of the i6 Green Challenge Program and longtime executive with the CleanTech Open, to kick off our presentation today. Ed?
Rebecca, thanks very much. Again, my name is Ed Murray. I am the Director of the i6 Green Program. The goal of i6 Green is to help accelerate the growth of clean energy companies. We recruit alumni of the CleanTech Open and also promising non-alumni as well. Our focus is on selecting and serving companies that are poised for rapid growth. Huge thanks go to Rebecca for suggesting this webinar and doing the hard work of setting this up through WebEx. Rebecca has provided support to many clean energy startups as part of the i6 Green program. Brett Anderson is presenting today. Brett has special background in crowdfunding and more broadly in startup financing and is ideally suited to leading the webinar. You have his background already on the invitation, and I will not repeat it now. Thanks go to Brett for preparing the webinar and presenting today. I believe we are ready to begin. Brett, please take it away.
Okay. Thank you, Ed and Rebecca, for the detailed introduction and setting up this webinar on crowdfunding. It's a real pleasure to be with you and the i6 Green program clients. I've been working with the CleanTech Open for several months now on questions regarding crowdfunding and new business models. And what we're seeing is that the venture funding and cleantech landscape itself is changing rapidly, so it's a great time to work with you all on the emerging opportunities and challenges that these changes are creating. So let's jump in. I'd like to talk about the agenda for a moment. I'll be focusing on basically three topics. We'll be going into how the investment landscape is changing. So there we're looking at the venture investing and angel investing trends. And then second, looking at what the emerging crowdfunding alternatives are looking like. We've got donation rewards models, debt models, project finance, and equity. Those are the ones I'll discuss in some detail. And then thirdly, we'll look at the crowdfunding examples and some success factors in these different models that hopefully will spawn some ideas among you as clients in i6 for developing your funding plans for your startup. Hopefully we'll have a bit of discussion and Q&A at the end as we can finish on time. So stepping back to the large view here, starting with the VC environment. VC funding model has been in question now for the last decade. It's recovering slightly, and I'll talk about that in a moment, at least in 2014. But in a general sense, we've really seen kind of a flat pattern here since the dot-com boom and bust, where the overall VC funding is not really keeping pace with the economy and what's going on generally in technology funding. If we look at what's happening within those VC funding initiatives, we've got giant firms now that are kind of consolidating into firms that invest in very large, scalable opportunities. So these would be the internet, web-based, online-based business model, software, of course, the additional biotech and other categories. But primarily, they're looking at companies that can be scaled very rapidly from valuations in the 100 million to 400, at least those funding rounds, into the billions of dollars for IPOs and exits. So these names like Cloudera, Tango, Palantir, Dropbox, these are the ones that are stirring the heart, so to speak, of venture capital these days. And if you look at the chart, you can see that most of the money, in fact, is going to these large deals. So we've got fully 80% of the money here going into deals that are valued over $10 million. many of them 25 plus, and as you can see, 100 million plus. Below that, we've got less than 20% going into seed and A round size deals. And the remaining small venture capital firms that are left are really targeting those deals and cooperating with angels as we're going forward. So looking at 2014, it's a pretty good start. We're up 50% on 2013, almost 10 billion in investments in Q1. And you can see from the chart that the software, IT services, and biotech health segments are getting the bulk of the investment. And we've also got an improving IPO and M&A market with some pretty high-profile exits recently that are encouraging to venture investments. Looking at the geographic spread, the main thing to note here is that venture investing is highly consolidated geographically into the Bay Area. So about 50% of all venture investments go into the Bay Area. And then Southern California, accounting for 8%, we've got a good chunk of money going through California venture firms, and very little going out to all the rest of the regions in the United States, only up to 10% in some of the East Coast regions. So that's quite a concentration of investment for technology firms. The other thing that's happening is while the volume of deals may be going down, the value of those deals is going up. So we're seeing fewer, larger, and higher priced rounds all across the board, from early rounds to later rounds. And if you focus here on the left-hand side, the blue and green graphs showing up and to the right since 2010, steadily increasing the valuation per round for seed A and B, and also the total amount invested for those are trending upward as well. So that looks good from an entrepreneur's perspective. Investments in these early stages and kind of stepping in with corporates to save the day as the venture funding capital, venture capital dries up. And there's about 700 million of that going into the U.S. right now. A better picture in the angel space than the venture space is this one for the United States, where we've only got 20% here in California. It's kind of based in the Bay Area, but it's a much healthier look if you look across the U.S. These venture angel groups are kind of all across the U.S. and represent a good cross-section of folks who are interested in financing the seed stage and A-stage ventures. So part of that, the enabler there, I should say, for angel investing is the online presence. It's required to reach more of the accredited investors and bring those into the investing network and the deal flow. So we'll see these groups going online. We're seeing VCs going online. We're seeing incubators and all of them going online to expand their exposure to the accredited investor world. Just to define that, the SEC defines it as an individual with more than $200,000 in income per year or a net worth of over $1 million. So those folks can all qualify to invest in early stage deals. There's estimated to be about 8.7 million of those folks in the U.S., and only about 3% of them invest in startups today. So there's good potential here to grow the network of angel investors across the U.S. to invest in promising startups in clean tech and other segments. And on top of that, the SEC, with the Jobs Act, has been easing the private financing rules. So for one thing, they've passed some rulings on some of the more popular sites of angels, collections of angels. These fall in the crowdfunding category, where they are allowing these folks to run their business based on carried interest compensation. So if they're able to do that, then they are excluded from the requirement to be a securities broker-dealer. That's typical of the old financing model for venture capital, was to have a broker-dealer license, managing those deals and taking some type of commission on those deals. And then the second element of regulation that's changed recently back in 2013 is 506C, which lifted the ban on public advertising of offerings. So now it's okay to go out in a public venue online and let people know that you're raising money for your company. The only requirement there is to verify the accredited status of your investors. And there are third-party services coming online to help companies do that, to help some of the online venture capital firms and crowdfunding firms get that done, so that burden of administration doesn't fall on the back of the startup company. And the other angle here is from the entrepreneur's perspective, or the startup's perspective, is the terms are improving as more angels move in, and the investors are taking smaller equity stakes. So even though, as we saw previously, the rising value of these early rounds, the rising prevalence of those deals, is we've got a decline in the amount of share that's being taken by those early stage investors. So that leaves more equity in the hands of founders if the company is successful and goes on to further rounds or some kind of liquidity in the future. The other key term that is declining is participating preferred stock. So non-participating preferred stock is prevailing. This graph shows the increase over time. It's very steady, but it's now more than 60% of the deals in the term sheets where the investors in the preferred shares have non-participating stock. Basically, what that means is they get less preference when there's a future financing round or an acquisition. Their preferred shares have less preference over the common shares when there's a conversion. So that's good for founders. And then thirdly, the transparency is increasing for these types of deals. There's an opening of the deal data. So a lot of these online sites of angel groups and some of the VCs and even the data reporting firms are exposing that data. AngelList advertise here that you can browse their seed stage startup valuations by incubator's location and other cuts. They've got tools and templates and term sheets and pitches, diligence processes, etc., that really standardize the process for raising money, which tends to make the terms a little bit more transparent and homogeneous from deal to deal, which is very good for, again, the startup founders who are trying to negotiate a sale of equity for their company. Focusing in on the clean tech segment, the clean tech segment, from a venture capital perspective, is showing some signs of recovery, not quite as much as what's going on with the, say, internet and biotech. But in the less capital intensive areas, we are seeing an upturn and recovery in some of the clean tech investing. So the orange you see here is agriculture, energy efficiency, smart grid, energy storage. The more traditional ones that were quite popular 3, maybe 6 years ago, solar energy, wind, and those have been ramping down over the last couple of years. So we're seeing some growth and recovery, and what's happening here, I think, is the clean tech is kind of being subsumed by other categories. A lot of smart grid, energy storage, or energy efficiency technologies now are being just called networking technology or cloud technologies. At least those are the reasons investors are taking an interest in them. Another factor contributing to clean tech energy investing not recovering quite as rapidly as other categories is the fact that most of the customers are in the developing countries now. So we can see from this graph, the red portion of the column here, which represents developing countries, China included, is growing, but the overall total is declining. So that means the US and Europe are declining in their consumption of clean tech technologies. This graph includes storage and digital energy, so smart grid type of technologies. So you can see that the developing country is really where it's at in terms of growth and volume in clean energy related investments. And about 50% of this is China. which leads me to an observation about the most recent data we have on investing in clean tech. This was a blog that was done by Cleantech Media, Rob Day. His title was "Smart Investors, Not VCs, Are Funding Growth Stage Clean Tech Startups." So he studied the 40 new clean tech deals that happened to May in 2014 and found that no sector was dominating. That is, there wasn't the dominant solar sector or say water purification or smart grid. All of them were doing well as long as they had a good business case. The venture capitalists, especially the clean tech specialist VCs, continue to pull back, so they are not contributing that much to the growth. And most of the lead investors on these rounds are coming from corporations, high net worth individuals and families, and foreign PE firms. And on that last point, 50% are coming from Chinese investors. So this is interesting. We see the interest in China in clean tech. They're making most of the investments over in the Chinese geography, but they are coming to invest in these technologies worldwide, including, in the U.S. So it's an interesting perspective, knowing that when you go out and do a crowdfunding campaign and you're in clean tech, the first person who may bring a term sheet to you might be a Chinese investor. So let's switch over now to look at the crowdfunding alternative. I tried to frame the venture investing landscape where the angels now are rising in importance, and online is allowing them to scale the investment coming from angels, and how clean tech is seeing a bit of a challenge in the traditional venture capital funding route. It looks like angel investing and crowdfunding is really going to be something that can put some wind in the sails of clean tech. If we look at crowdfunding overall, it's a very large and diverse market. There are over 450 sites now in crowdfunding. They span these different types of business models: donation, reward, debt, project finance, equity. I'll go through each of those and define those in the ensuing slides. But if you look at this graph, you can see where the venture capital investments in crowdfunding sites is going. So these are actual crowdfunding sites receiving venture capital up to early days of 2014. So it's a pretty good indication that crowdfunding is a model that's here to stay and receiving a lot of funding from investors. Basically, you can fund any type of project you can imagine using various platforms, and it's quite a global trend. So we see a lot of platforms starting in the U.S. because of the internet startup culture, but a lot of them are designed to facilitate investment back and forth from different regions of the world, from, say, rich investors to developing country entrepreneurs, from developing country business leaders and investors into developed country technologies. So it's a very interesting time to be in the venture investing activity. So looking at the different models one by one, first donation and rewards crowdfunding. This is donation by definition, someone giving money with nothing expected in return, nothing tangible, except to know that they are supporting a good cause. Now, there may be some perks associated with that. You may be have special guest list on a film, or attend the event that the project is financing, get a sample of a new product, participate in a development project. The sites that are growing fastest here are the generalist sites, Kickstarter and Indiegogo. As you can imagine, there's a large networking effect in this type of an area where the bigger audience you have, the more projects you attract, and it snowballs. So Kickstarter and Indiegogo have kind of got the first mover advantage in this area. But there are many other different types of sites focused on, for example, social good, Rocket Hub, Start Some Good. These would typically be nonprofit endeavors, community projects, and the like. And then green projects, which might be retrofits to schools and churches, providing insulation to underserved communities' homes, changing behavior and conserving more energy. organic food, those types of things. Not necessarily tech, but there's almost a category for every subsector that you can think of. The typical amounts in donations and rewards crowdfunding are below $50,000, so $7K on average. Now, there are thousands of these campaigns, so that's not necessarily bad news. If you're a product company and have a tech proposition, there are some successful product campaigns that have reached the 100,000 to even 10 million plus dollars raised. Definitely, you've got some kind of mass appeal going on here. But when anyone can donate and anyone can fundraise, you're bound to connect the two to some very profitable results in the end. And then finally, the way these monies are raised are either in the all or nothing mode or keep it all. All or nothing means if you reach your goal or go above your goal, you can keep the money and use it for your project. If you don't reach your goal, you have to return that money to the donors, and basically, fold up your notebook and manage your project some other way. The alternative to that is keep it all, where you may have a goal of funding 25,000 and you only get 5,000. You can keep that 5,000. Of course, these expectations are set up front, but it looks like all or nothing goals seem to be the ones that are the most popular and definitely the most applicable if you're talking about product companies and technology. Moving on to the debt crowdfunding category, really what we're talking about here are loans, fixed interest loans that would be based on peer-to-peer or small business. And then there's also a third category, microcredit. But briefly, the peer-to-peer lending is Lending Club, Prosper, Common Bond. Those are the example players there. They provide a fixed rate of interest on funds invested, but they're really going after retail investors that may put in as little as $25 into their investment. And they're using public securities laws, so they've managed to meet the requirements that the SEC imposes, as well as the requirements on a state level in certain states. And there are quite a number of states that don't allow this type of model to go on in their territory. So it's state by state, hit or miss, whether you can benefit from these type of investments. On the small business loan side, these are only available to accredited investors. Now, we can pool investments from accredited investors into small businesses. Funding Circle is an example. They provide loans up to $500,000 for small companies, and deal struck from about $50,000 to $250,000. And they're fixed or variable interest rates, so they're better than the bank. Sometimes the bank won't even lend to some of these small businesses, but in a broad sense, it's similar to the type of small business loans you might get from a bank, but on favorable terms. And microcredit is really in the international development range, as well as impact investors who want to do some good, perhaps get paid back low interest, perhaps get paid back with no interest. But those are really for impact investors. So to summarize, before I move on, the debt crowdfunding category is really for individuals or businesses that have a steady, predictable cash flow that would normally be financed by a small loan from a bank, 3 to 5 year period, but for whatever reason, that big financing is not there, or just not as good a deal as what can be had on crowdfunding. Another form of debt really is project finance, and this is more interesting, I think, from an I6 and clean tech perspective, because we're talking about funding projects that are retrofits or development projects for buildings. I'm listing 4 examples here. It's a very early day picture for this type of funding. Mosaic, Spark Fund, Abundance Energy, and Sun Funder. Mosaic's a specialist in solar installations. They're probably the first one that's really had smashing success here. As you can see by this map showing their deployments, they've managed to invest about $5 million so far. That is pooled investments from investors. They're matching investors to commercial and residential PV projects. But what they're finding is that the residential market is more interesting from a financing perspective because it's a more standardized business and there's not as much difficulty in the sales cycle or the actual specification of those projects and execution. Whereas in commercial deals, and I'm sure some of you may know this, a commercial customer may have multiple parties involved in that property, the tenant and the property owner, as well as other business interests. The sales cycle can be pretty long, and those agreements are typically negotiated on a custom basis, so they're not cookie-cutter agreements. So those are primarily the reasons why Mosaic is now focusing on the residential market. Spark Fund is a new player, one to keep an eye on. Today, their platform's not available to finance projects, but they intend to introduce it in 2015, and they're already developing a partner and project pipeline. Rebecca knows a little bit about this one already, having had a conversation with them. So they're very interested in talking to companies that could be potentially workable with their model. Their customers are commercial energy users interested in efficiency retrofits, and they provide $50,000 to a $500,000 cash flow equipment leases for those customers. And these last two are based in the UK, and one provides developing country solar, the other UK wind and solar, similar to the lines of Mosaic. So for now, they're UK based, but they are looking for investments that might be overlapping with their mission in other geographies. In the equity crowdfunding category, this is probably the most applicable to you in the audience today. Essentially, this is the crowdfunding label put on angel investing in the Regulation D equity financing modes. So Regulation D is basically the way investments are done in venture capital and angel investing today. There's nothing new here except that they're moving online and having the networking and matchmaking and deal processes run in an online community. These are private deals that happen under the 506B rules of the SEC or public solicitation now that ban has been lifted under 506C. Investors may invest directly or via specific funds. So to manage the number of investors that come into a startup during that campaign, you may have a smaller number of individual investors owning your stock outright, or the crowdfunding platform may form an LLC, pool those investors, and then have that LLC be one investor in the startup company. So you can manage the number of investors you have by working carefully with these crowdfunding platforms. The top sites I've listed here: AngelList, AngelList, CircleUp, OurCrowd, Crowdfunder, Return on Change, Microventure, Seeders. The list does go on, but there's a few of these compared to the donation crowdfunding or the debt crowdfunding sites. So we'll look a little bit more detail on these later in the presentation. One point I wanted to make is that this equity crowdfunding is really here to stay. It's growing very rapidly, and I think it's a more efficient way to get funding out to startups from interested investors. So this infographic shows some pretty interesting statistics. While equity crowdfunding was only $200 million in 2013, it's moved to about $700 million projected in 2014. So that's about 7% of the total crowdfunding market, whereas in 2013 it was only 4%. So it's a growing portion of crowdfunding. Typically, the crowdfunding raises are much higher than you get in a donation campaign or a peer-to-peer lending or debt campaign. So I expect this to take more and more a share of the crowdfunding segment going forward. And the reason I think so is because of these statistics on the side here. Looking at the successful crowdfunding campaigns, the companies that do those typically have follow-on rounds with institutional investors at a rate of 71%, or at least are in serious discussion with institutional investors after that campaign. The sales increase for those companies is about 351% on average. and those companies raise over 1 million at a rate of about 8%. So that's a pretty good size chunk for these early seed and A stage companies raising money, if 8% or over 1 million at this point. So this does bode well, I think, for the future of crowdfunding. And definitely, if you're raising money now, you should be taking a careful look at it. And the third thing that is coming, which is Title III, which I'll speak about in a moment, allowing retail investors, then small investors, non-accredited investors, to invest in company startup equity that should really drive the growth going forward as well. A little bit more on that Title III point. It's for small investors, and of course there are a lot more of those than the accredited investor segment. The draft rules, which are not finalized yet, those are to be announced. We're expecting them, say, toward the end of 2014, but it is up to the SEC to determine the schedule there. But their draft rules indicated that anyone could invest up to $2,000 or 5% of their annual income. And that startups may raise $1 million per year for that round. So they could raise 1 million one year and 1 million of the next year. And then there would be some added financial reporting requirements to protect those small investors, including audited statements if you're over $500,000 in revenue. So there are some other requirements as well as these, and that does place some burden on startups that would be trying to attract these type of retail investors under Title III. But the sites, crowdfunding sites that are positioning to take advantage of this should make that easier for startups to manage this process and take care of that extra administrative burden. And those include Kickstarter, Fundable, Crowdfunder. I think all of these and more crowdfunding sites will be positioned well to take advantage of these rules when they become available at the end of the year or somewhat later. How are we doing on time, Rebecca? Can I rely on you to jump in if I'm at risk of going too long?
Yeah, I will do.
Okay, thank you. So looking at equity, the scope of equity services from crowdfunding sites is basically in three main areas: curation, platform and tools, community, and network exposure. So these are the things to look at if you're looking at a crowdfunding site and thinking of working with them. On the curation side, that's really the traditional role of a VC, which is screening deals. VCs and some of these crowdfunding sites will only approve 1 to 2% of the total deals that they look at. So the bar is pretty high. There are many startups looking for funding. They may foster those that look sufficiently promising, and some of those sites also just let the crowd decide. So they're not hands-on in the sense they're using experienced VCs to evaluate these deals, but they're letting the full network of accredited investors and folks looking at these deals vote or support deals, and those that reach the highest number of votes will pass on to the next stage of doing a campaign to raise money. So that's really using the wisdom of the crowd in crowdfunding. The platform and tools, these are all to more or less extent present on these crowdfunding sites. These really make it efficient to raise money these days, and the content and tools that you use on one site are leverageable and similar to the ones you use on other sites. So using multiple sites is possible, so developing your content for these sites can be used on multiple sites and multiple rounds. But they cover tools and processes for pitch, developing your pitch, documents for legal agreements and structuring your equity, doing the social networking tasks, doing some of the campaigning, contact, email management, and of course showcasing your business. I forgot to mention that. That's the primary idea, is to give an investor a very concise and quick way to assess what your company does and its prospects. And then the third major area of value here is how big the community is in terms of investors and advisors, strategic partners, potential customers, other entrepreneurs, and potential employees. So all of these people are involved in the crowdfunding activity, present on these networks, and the contacts that you can potentially make there should be important in terms of deciding whether you're doing crowdfunding, or at least should attract you to the whole crowdfunding activity if you're raising money. Simply put, the process for going through crowdfunding on equity, and this is analogous to what you might do on a donation site as well. 4 steps: basically, do your profile. Number 2, allow the crowdfunding site and its team to do the inspection, do the due diligence. Provide the, excuse me, sorry. Okay. So number 2 was to let the team do their diligence and give a go, no-go decision on whether they have you run a campaign on their site. That would be number 3 here. If you're approved, then you've got to deal with the visitors coming and looking and asking questions about your campaign. And then finally, number 4 would be once you've successfully achieved your goal, then the backroom processes are put in place: signing agreements, documentation, setting up the transferring the money, and setting up the other administrative requirements for managing the deal. The heavy lifting here for the startup is basically in the first stage and the third stage. So before going in, having your profile concisely done, having it complete, and lining up your lead investors and supporters and followers is really important to make sure that you start out on the right foot before you go into evaluation by the crowdfunder team or its backers. I should mention that this graphic here was borrowed from Crowdfunder. It's an infographic that they have on their website, but I'm using it because the process is fairly similar from one site to the next. There's really these 4 steps, and the work that you're going to do as a startup going into this process is really the same. So the second area of that work is the campaign planning and management, intensive email and calls and meetings with investors. So that's what it's all about, really, when you're trying to raise money in the real world, and here online in the virtual world, it's the same thing. You'll have to treat and be very responsive to those investors. You may have to meet with those investors, have calls with those investors, and screen those investors. So that can be a lot of work as well. So let's look at some crowdfunding examples and success factors here quickly, if I can make sure I finish and have some time for questions. On the donation side, looked at a couple Clean Tech Open alumni examples. Some met their goals, some didn't. Incidentally, when these slides are made available after this presentation, you'll be able to click through on these links and see the full crowdfunding pages or websites of these companies. So you'll get all through the presentation the ability to click through and see the sources for what I use to create this content. So if there's any details missing here about the content, then that can be followed up through those links. Illumi is an LED lights for consumers startup, and they were very successful in raising $145,000 of their $25,000 goal. It had high consumer appeal, was a very clean and good-looking presentation, so no surprise that they met their goal on actually a fairly modest fundraising campaign for that type of product. Greentown Labs is very interesting that in contrast to a consumer product like this, a clean tech incubator can also raise sufficient money to get a key project done. They raised $32,000 out of a $30,000 goal. And they had a compelling community project to complete a move to a new facility for their entrepreneurs. So it was a very specific project that attracted that money and interesting interest from investors that are community-minded and want to have impact with their investment. Some goals that were not met included Radiator Labs and Almaterra. Radiator Labs raised about half of their goal, almost half. They launched their own e-commerce site and probably will have more luck targeting customers that have their particular configuration for Radiator and use their product in their part of the country. since they were really designing it around a particular type of building and situation for heating inside those apartments. I think this one was based in New York. And Almatera, that had their campaign on Indiegogo, didn't do that well in terms of meeting their goal, and part of that may have been not having enough mass appeal to the broad public. They were really a government or corporate target customer, and also selling material that was used for building infrastructure and levees and landscaping projects. Other examples from clean tech which are important to note because of the size and nature of their activity was a Flywheel energy storage company that raised 56,000 rather on Kickstarter. A thermal imaging company that provides an application that runs on an iPhone and raised 282,000. So in this case, you're really validating a product and also some of the features of that product by going through one of these donation campaigns to fund a particular product. Violite is a very interesting stove that can burn material that's available in the local environment and charge your electronics, 390K on Kickstarter. And then Solar Roadways, which is really an infrastructure type of product, but had a very compelling vision. If you look at their campaign about how that product might be used and how it might change the lives of people living in any community. So a lot of mass appeal, and they raised $1.5 million to study in more depth and provide some of the engineering development required to get that product onto the market. So we're talking about many, many small donations, but a very inspiring story that adds up to a significant chunk of money for developing their product. We're going to look quickly at the success factors here. These are the kinds of things that you can find if you do enough studying of these cases online or talking to folks. Obviously appealing to a broad audience, whether it's a consumer product or just a concept that could change the lives of many people. That's an important ingredient to success on donation if you're trying to raise significant funds to finance product development. A lot of it is about refining that pitch and focusing that pitch in a very short story. Why you're doing that project, having a good prototype and a simple project plan, a specific deliverable on what you're going to provide, and transparent use of those funds. Looking at the range of perks to upsell. So this gives all the donors many different price points that they can use to contribute to your project or your product. Sweet spot is about $30 to $50, but the perks can come in the range of $10 to $1,000 or even more. Buy one, get one free, signature limited editions. Setting clear expectations on those perks and perhaps refunds if the campaign changes in nature or doesn't achieve all of its goals. That's very important to allow anyone, say a price point, to participate in your campaign. A deep understanding of the feasibility of doing your product. There are a large number of hardware product concepts that don't get delivered because there were IP issues early on that they discovered after the campaign. They didn't have a good design for manufacturing. They didn't look at the cost of manufacturing. So these are really keys in setting and meeting delivery expectations. So just getting the money is a small part of the battle in terms of delivering a new product, of course. And then the pre-promotion and intense campaigning after that launch. I can't overemphasize this. You've really got to line up going into a campaign, all the people who are going to support it for donation or equity, friends and family, blogosphere, local news, have those things teed up when you launch to provide some momentum, and then provide that online social media marketing drive to follow through and manage expectations while that campaign is running. So I want to talk briefly.
Sorry,
yeah.
I didn't mean to interrupt. Just want to let you know we've got about a little less than 10 minutes left now. So
okay.
I think this is critical, the project finance slide, obviously. We should make sure if people do have questions to ask, we'll get to those.
Okay. I'll try to be as expedient as possible here. So moving on to project finance. these are really pooled investments for specific projects like solar panels on a rooftop or efficiency retrofits or building rehabs. You could think of real estate in terms of a building rehab type of project. But really the financing here is coming in because it's a low-risk project, especially in terms of the technology risk. So if you've eliminated some of that technology risk and it's more a question of business model, finding customers and proving out the financial flow, then this may be an option for a clean tech company. The fixed returns for investors have to be more or less guaranteed, and they're typically a better rate than from the banks because there's no middleman in this transaction. And I went through the examples already: Mosaic, SparkFund, Abundance, and SunFunder. So to keep an eye on is SparkFund. I think it's key for the clean tech folks, and there may be others coming online that I can't cover in this presentation now or may actually arrive this year. Looking at equity crowdfunding, I want to split this up into 3 different categories for you all. Some of these platforms are really broad, not as deep in terms of how involved they get in the actual venture capital side of funding. AngelList and EquityNet are really kind of the Match.com of equity crowdfunding. Very large networks, lots of people meeting, lots of different startups. So there's a lot of noise, and there may be things that you need to do to break through there. But they're definitely have a lot of value. If you've got profiles there, you're getting exposure and networking. Second would be the strong crowdfunding platforms and tools with some hands-on service, almost getting into the VC type of sites. But these folks, the Crowdfunder, Return on Change, Fundable, have expressed an interest in cultivating clean tech startups doing campaigns on their site. So they seem to be solid and are having some good successes in the clean tech space. And then thirdly, we have the VC-oriented, more traditional type of organizations moving online with the platform, Microventures, Our Crowd, Funders Club. What you may see are these folks being a little bit more selective. Funders Club is by invitation only, so no angel can just kind of jump in there. An angel has to be referred or get an invitation from another to join their network. Our Crowd is also heavy VC background, and then also based in Israel, by the way. And Microventures is also one that would say if they're going to invest in you to do the curation and screen you and develop you for their investing network, they would not want that startup to be doing campaigns on other crowdfunding platforms. Some of these other platforms really don't mind if you're on multiple platforms and doing what you can to raise money, but these folks invest a little bit more upfront and they want a little bit more exclusive access for their investing network. Just 2 success stories to go through here. Again, the details will be available if you want to click through when you get the slides. But GeoStellar was a successful campaign on Return on Change. They raised $1 million for their round. Basically, it's an iPhone application or PC application that shows you by address what your solar potential is and gives you comparable solar plans from installers in your area. And then Lucid Energy is kind of energy harvesting from city infrastructure, in this case, municipal water pipelines, which I think is probably similar to some of the products that are being developed in the i6 and CleanTech Open portfolio. So it's also a very interesting product and case to look at. That one done by Our Crowd. So again, it was an Israeli company, but they're moving overseas to try and finance startups. This one, Lucid Energy, actually being based in Portland. So quickly, there's the success factors for crowdfunding before we close and go to questions. Similar success factors to what's going on with the donation campaign. You've really got to be focused about putting your attributes up. The VCs and angels that are on these networks will apply the same benchmarks as far as the idea you've got for your product concept, your market potential, your team, the business model, how you're going to make money, and then the traction. This includes, of course, lead customers and investors, but also past success doing a donation campaign on Crowdfunder, on Kickstarter or Indiegogo and the like, being a graduate of an accelerator like Cleantech Open or some other incubator. So those things are key in terms of your ability to raise credibility for your business on these crowdfunding sites. And then a clear presentation of and communication of your company. It's a pitch deck. Video is kind of becoming standard, so investing in some professional help to have that looking good and professionally directed is very helpful. An executive summary and a plan with some financial projections is also key to success in raising money on these platforms. Building momentum, having some past investors that are well-known, a well-known VC or angel or strategic investor is important to start building that momentum and convincing others that you're a good investment prospect. And the social proof from communities, blogs, Facebook, Twitter, local press, whatever that is, the more people who are talking about your company, creating that buzz, improves the visibility and credibility and substantiates the attractiveness of your proposition. And then again, the intensive campaign and marketing, less so than in the donation mode or donation crowdfunding websites, because those are typically to consumers and trying to reach out to many, many small investors and small donors. But in this case, the planning and execution, responsive email follow-up for investors, updates and progress like big customer wins, those have a very big impact on your momentum and attracting a few more key investors to finish off your round. So those are definitely activities that will keep you very busy after you launch a campaign. But definitely running through this process and meeting these criteria can save a lot of time and money on a crowdfunding platform rather than going out and trying to meet face-to-face with all different venture capital firms or angel firms across the country. So those crowdfunding sites really are there to save time and effort in those campaigns. So
Great.
I'm wrapping up.
Thank you. Yeah, appreciate it. I know we went a little long, guys, and we didn't get any questions in the chat window as Brett was presenting. I want to suggest that since we're at 3 p.m. Pacific Standard right now, if you can stay and would like to stay, please do so to get any questions you might have asked. If you have to drop off, we won't be offended. But I did want to make sure people had a chance to, pipe up here. So feel free to take yourselves off mute and ask any questions you might have, and we'll go ahead and hope somebody has one, because I know I have a few.
It looks like we still have a few people on.
Yeah. Hi, Brett. This is Mark Borman in Minneapolis.
Yeah. Hi, Mark.
Thanks for the great presentation. It was a good, really, really good overview of the depth and breadth of what's out there and where it can go. So, so what I'm trying to, and I've been talking to a number of different crowdfunding sites as well. I'm trying to figure out, where to spend my time and effort, and I haven't really found the one with, enough of a clean tech investor crowd. Most of them say they have something, but then when you dig into it, it's like maybe one or two companies. It's not a big following, and plus, it's not totally clear they have a big crowd of investors. So, and then the other part is a number of us are commercial or more capital intensive than a consumer product that you can do on Indiegogo, where you donate $20 or $30 and you get a little device of some sort. Mm-hmm. So I guess what I'm trying to figure out, and sounds like you've done a lot of research, maybe are still trying to figure this out, or maybe it's still to be developed. But are there some where there's enough of this high net worth family office crowd? It sounds like maybe it's in more of those, in the ones in the last few slides. But I'm just trying to figure out where we should be spending our time and effort if you're a commercial product that's capital intensive?
Yeah, so I think the one example that I did show, which was the R crowd, that was the energy harvesting. I think that that one, Lucid Energy, is the most analogous to what you guys are doing, right? Shearwind.
Yes, that's correct.
Yeah, so they were done by R crowd, and so first I should step back and say there is no crowdfunding site that I've found that has a large clean tech focus. It's kind of onesie twosies across the board for all of these companies.
Right, that's my experience.
Yeah, so if you can tie your story into one of the, say, more, one of the segments or the industries or the business models that are successful compared to, other startups, not labeling it clean tech, I think, just is kind of too general. You've got to go more after energy harvesting, for example, or something that is fundable and has had some successes on other crowdfunding platforms, or even through regular VC funding, and use that approach. So I would say these are all candidates for you, I would say. Definitely our crowd, because they've done such a similar one. It would probably be good to just talk to them, because your case is very similar, I think, and you've got a lot more potential avenues to pursue as far as the value add.
Okay. Are there any other questions? I don't want to hog the whole time.
I didn't really have any, so feel free to go ahead.
Okay.
Unless anyone
else so then it kind of gets down to I6. You guys have done a lot of great work in trying to figure this out for us. So again, thank you for that. So now, as a follow-on or as additional services or whatever, is there a role that you can play in helping companies such as us and others in your, I don't know what you call it, service list or client list, to get to the right sites for the particular company, whether it's commercial, consumer, what have you?
Yeah, I can definitely help you with that. I think it is a combination of two things. How does your business plan look in comparison to the other companies that are getting funded out there, clean tech or not? And also looking at what your objectives are, whether you've had funding, do you need smart investors, or is dumb money okay for you, so to speak? Some of these guys at the bottom of this list, I don't know if you see this on your slide, but the curation, traditional hands-on VC, they're all about trying to get smart money available for companies that they're doing business with. And the folks at the top, AngelList, EquityNet, I mean, any angel investor that comes in, or any accredited investor comes in, can come in and put money into their startups, and they don't mind. So you're going to have to do your own work in terms of filtering or searching for the investors that you want. Hopefully in there will be some good ones. But your goals kind of factor into this too, in terms of what you're looking for crowdfunding. But I think it's a fairly extensive kind of custom conversation, at least at this stage, because it's such early days for this industry. We don't have a lot of stats for your particular type of product category.
Yeah. Okay. And then the other thing I'm finding is not so much on the crowdfunding sites, because all Indiegogo and Kickstarter are all pre-revenue products trying to find funding, but it seems as you get into the more sophisticated investor, as smart money versus dumb money, that the more smart money is looking for more post-revenue type ramp for validation, where the dumb money will buy the idea but doesn't get too smart on the valuation. So are you finding that these curation, traditional hands-on, act like traditional VCs, or that they are VCs and so they are more post-revenue oriented?
They'll be a little bit more critical, I think, of that of those attributes. So their filter is going to be a little bit tougher in that sense. But you can it's not to say that you can't overcome that particular say weakness with some other evidence or traction, or the story is got to be complete.
Yeah. Well, we're just finding we run into a lot of people on stop and wait for the revenue.
Yeah.
Well, we're early day. We're revenue generating, but we're still early in the cycle.
Yeah.
Okay.
I would add.
Go ahead.
Sorry, it just spurred a thought also that I have seen companies go out there and do a campaign around a particular product or project. So for your case, you may structure a project and a campaign that will fund the deployment of one of your products, which are fairly expensive custom projects, and get a lot of community excitement, as well as the bigger vision and impact investing public to say, hey, I'm willing to donate a small amount for this because it's just a cool idea and I want to see it happening. Let's just be part of it. And it could help you kind of test the market, get a project that you learn a lot from, and really show traction for later equity round.
Okay.
So it's an idea.
Yeah,
the other one is that in my digging around in the right guy's backyard is the Clean Tech Group. They have that new, well, it's not new, but they're using the i3 platform and they're running campaigns on it for particular corporate strategic types. Mm-hmm. Are you familiar with what they're doing over there?
No, I haven't. I'm just kind of cursorily aware of what they're doing.
Yeah, well, you ought to just check out the i3 platform. And so they're getting very more proactive in marketing. So what they do is they could bring in corporate strategics like ABB, EDF, GM, Kozla was on there, and they run campaigns for them, which says, hey, we're looking for people on our i3 platform that have conserved these types of needs at the particular campaign that's looking to attract companies to help them solve these needs. So it's more the buyer putting out their spec list of what they're looking for, and then companies like Shearwind and others in the database can then apply. And there's the questionnaire with the very specific things that they're looking for, and then you have to respond to how you meet that criteria, all online, and it's getting pretty good. So then they followed up with me on a phone call because I've applied to a few of them, and they asked me, how is it going? What do I think? Trying to see, from my end, how I'm experiencing it, which I thought was very thoughtful. And then I said to him, well, you guys, you can take this thing one step farther because you already have all these clean tech companies, and you can just add a crowdfunding platform onto this i3 thing, and you're already there because they already have the profile on you, right? Mm-hmm. And they just had to add a couple more back-end things to it to get it into a crowdfunding thing. So I don't know if they took that to light, but I thought that was they could pretty much own the space for clean tech crowdfunding.
Yeah, I think they also there's kind of an alternative model here, which is called crowdsourcing, where you put out a spec and you have companies bid on that, and the winning bidder gets the money that was put up for that.
This isn't so much crowdsourcing because they're almost acting like they're corporate strategic investors. The way the campaigns are written, it's not kind of like it's not like you're doing an RFQ or something. You're almost like it's giving you access into their corporate strategic parts of their business.
Right. Outsource corporate R&D. Yeah.
Yeah. So anyway, you should become aware of it because I think there's something there that could, if they could add a crowdsource thing or crowdfunding thing, I think they would be dynamite.
Yeah, that's a good reminder to let everybody know that Brett, of course, is going to be making this PowerPoint slide deck available to all the participants today. We're going to have some form of on-demand version, probably a slide share, And if you have questions that you would like to ask Brett, Brett is an advisor to the i6 Green Challenge program. And Brett, why don't you go ahead and let everybody know how to follow up post-presentation send out.
Or you could, maybe it'd be easier to do it if you do it with the slides.
Yeah, he's going to
You're
send
going to distribute the slides by email to data.
Yeah, yes, he's going to be sending those, but we will also be making a slide share probably of the slide deck available. But he's going to give you all his PowerPoint presentation, and he's available as an advisor as well, which I highly encourage everybody on the call, if you haven't had that idea already. There's a lot to this, as everybody can see, and you need a media relations effort in place. So there's a lot of planning that should go into this if you think you're going down this path. I think Brett would be a really great person to talk with further about that. And the other thing I wanted to add lastly is also that we are considering doing a second part to this, where we're going to invite possibly some actual crowdfunding sites and or possibly some companies that have been successful using this crowdfunding model. So stay tuned for that. Hopefully, if we can get that going over the next month or so, we'll be inviting everybody back to hear some firsthand stories there. But I know we are pretty much over, and I did want to invite anybody else on the call here to ask a question. I know Paul asked about Rock the Post. Looks like they've raised $31 million so far. And Brett, did you have any wisdom about Rock the Post? They weren't mentioned in your deck.
Yeah, I haven't seen much as far as clean tech activity from them, but I haven't examined them or spoken to them personally. So I know they're definitely one of the players that should be considered out there. I think it's such early days that just whether they have a clean tech deal or not shouldn't be the sole determinant of whether you use them. But they're much more popular and working, I think, from their base in the eastern half of the U.S.
Okay, and we'll make sure and look at I3 as well, Mark. You're great, as per your great suggestion there, and maybe can come back with a quick update on I3. Are there any more questions here on the call before we end the meeting? It looks like we're good to go here.
Okay.
So again, feel free to follow up with Brett directly. You'll have an ability to contact him when you receive the PowerPoint from today's meeting. Thank you again, everybody, so much.
Rather, the email address there on the thank you page is fine too. So I'm welcoming any kind of inquiries.
Right. There you go. I forgot to mention that's down in the left-hand corner of your screen. And thank you again, everybody, for taking time out of your day to do this. And thank you, Brett, for this amazing consolidation of information. We're so grateful to have your time for this.
Well, you're welcome. It was a real pleasure. Glad to meet all of the i6 folks, and hopefully there'll be some interesting discussion in the future.
Thank you, everybody.
Okay.
Thank you.
Bye-bye.
Thank you, Brett. Bye for now.